Good evening, I'm Ed Grant, and welcome to Ask the Specialists. Tonight, we ask the CPAs on CMU Public Television.
Support comes from Smart Investing at Your Library, a partnership between the Genesee District Library, FINRA Investor Education Foundation, and the American Library Association. The mission is to provide the public with knowledge, skills, and tools necessary for financial success throughout life. More details at thegdl.org.
Excuse me. Tonight we have two experts with us, local CPAs, individuals who know a lot about the tax world and business planning and individual financial planning. And I'd like to start now by introducing Keith Frame, who's a CPA right here in Mount Pleasant with Robert F. Murray and Company, and also Lynn Pohl, who's with Bogwai and Bradley, PC in Mount Pleasant. They're experts on this show. They've been here before. They were eager to take your questions to get to some of the things that have been bothering you as we're getting close towards the end of the tax season, or maybe if you're looking at certain types of business opportunities or individual planning opportunities as well. You see the number at the bottom of your screen. You can call that number and we will get those questions answered here on the air. You also notice that we can take your questions via Twitter or Facebook. So if that's your method that you'd like to use, that would work out just fine as well. Let's first off talk about, and this is a real interesting time for all this to happen given the election last week, with the possibility of increases in tax rates due to the expiration of the so-called Bush tax cuts. What advice would you folks give to individuals in making year-end tax decisions? Maybe we'll just kind of see what each of you have to say. Lynn, would you like to go first on that one?
One of the first concerns that I hear most people ask about, and it's a large unknown, is the change in the capital gains tax rate structure. There's every possibility that those rates will go up from potentially 0 to 15% that we have right now up into 10 or 20% in the future. There could be a lot of things that aren't as favorable about that, and so if someone is thinking about selling some type of capital asset, they might want to think about whether they want to structure the sale so that it occurs still in 2012 as opposed to waiting until 2013.
Keith?
It's very difficult planning. We really don't know what's going to happen. We're assuming the worst and that the Bush tax cuts will expire, and as Lynn said, capital gains are a big issue. One of the other very big issues for wealthier clients is gifting. There's a lot of estate tax changes that are going to be taking place here. There's an opportunity through the end of the year to reduce taxable estates, and that's one of the things we've seen a lot of recently.
Okay. Let's get one question out here on the table because it came up a lot during the election. Are just the high income earners going to be affected by the drop-off of the Bush tax cuts?
No. No, in fact, one of the big changes that'll affect a lot of people is the reduction in the child tax credit from $1,000 to $500. So everybody's child tax credit will be affected. There's a lot of other factors. I mean, the tax rates themselves, I believe all of them go up by 3 or 4 percentage points except the 15% bracket. So it will affect a lot of people.
We're also talking, or the legislators are talking about limiting itemized deductions, and so a person might have less deductions from their taxable income, thereby increasing their taxable income, and then applying a higher tax rate to it.
The hidden tax rules.
Right, the hidden tax rules, right. Well, obviously it's a kind of an unnerving time around the country now as we look at the impact that might happen as a result of some of these changes in tax law or repeal of some of the prior tax cuts, so we'll see how that unfolds. Here's another question. If I want to sell some shares of stock that I purchased over an extended period of time at different prices, how do I determine the cost of those shares that I would use on my tax return for calculating presumably gain or loss? I mean, is there a standard way to do it? I mean, other than maybe just specifically itemizing it?
If you're selling all the shares, you can add up the cost of all of them, and that's relatively easy.
Right.
If you're selling some of them, you've got to either decide on the specific identification or the first in, first out method.
Okay.
You cannot use the average cost method, which you can use with mutual funds.
Okay.
And that supposes that you're not working with a broker, because if you are working with a broker, typically they will track that for you, and you should just get that information from them.
And first in, first out means that the ones that you bought first would be the ones associated with the sale that you made.
Correct.
Right? Okay. Okay. What's better, a 401 retirement plan, 401k retirement plan, or an IRA for tax purposes? Is there any general, I mean, obviously there's differences because some of them are.
For tax purposes, the 401k is definitely better if you are able to contribute more to it. With an IRA, your limits are so much lower. And if you're looking to shelter more of your income, you would like to be involved in a 401k plan, but that needs to be through an employer, where an IRA is available to anyone with earned income, or even if your spouse has earned income, you might be able to get into an IRA plan. So it depends on your needs and your qualifications.
But always look to join that 401k plan if it's an employer-sponsored plan, because typically there's a match involved, and that's free money.
For the 401k.
Correct.
Call from Traverse City. This individual pays for college expenses for their grandkids. Are there any tax breaks as a grandparent for that?
There's no deduction for that. If they contribute to the Michigan the 529 plan, they can take a deduction on the Michigan return for making contributions to that plan, for which the money is then used for education, now or later. But directly paying the educational expenses, I believe it's not considered a taxable gift, so it doesn't fall into those rules. But no, there's no deduction for it.
Okay. Once again, just to inform our viewers out there that you can give us a call at the number on your screen, or contact us via Twitter or Facebook to get those specific questions into us, and we'll see how many we can get answered here in the next 20 minutes as the program continues. Let's talk about, here's one that, a question from Bay City. The feds offer a deduction for health insurance. Why not the state? So there's a time to editorialize.
Well, the state doesn't offer any sort of itemized deductions. So in other words, the state doesn't allow you to deduct your mortgage interest expense. They don't allow you to deduct your property taxes that you pay. And so it's just not a setup with the state. Your state return is much more simplified, and your tax rate is also lower. Maybe that's the trade-off, but it's not a part of the state plan.
Deductions are an act of legislative grace on the part of the IRS, or the federal government, I should say. And those are being more restricted, next year, medical expenses in particular being more restricted next year anyway by the federal government.
And in particular at the state level, what credits, not deductions, but what credits there were, many of those disappeared.
Many of them.
Most all of them, I believe.
I think if the word credit on the item was...
I think the state of Michigan return this year may be 5 or 6 lines.
Yeah.
It's that much more simplified.
Exactly. I've recently retired and started collecting Social Security. I have an opportunity to work part-time. What are the rules on how much I can work?
Well, it depends if he retired early under the Social Security rules. If he did not retire early, if he retired at his normal retirement age, he can work as much as he wants and earn as much as he wants.
So the normal retirement age for a lot of people like my age even is like 66 now, and it gets older.
I was going to say, I'm not sure what the age break is.
I think that sounds about right, 66.
About 6?
Yes.
So if you're at full retirement age, you can work as much as you want and still receive all your Social Security benefits.
And if you're not at that full retirement age, if your earnings on a job are more than ballpark about $14,000, then you could potentially lose some of your Social Security benefits.
Okay, here's a question from Lakeview, another 401k question. Let me see if I can work through this for just a second. He has an early withdrawal from a 401k retirement plan, and they took a 20% charge. They charged at 20%. Is that the taxes? Is that a tax or a penalty? And how is it reported on their tax return?
That is not the tax or penalty. That is nothing more than withholding. So you have to report the income on the tax return and work through the rest of the calculations. And if it is an early distribution, it's subject to 10% penalty, as well as the tax.
So the 20% that this individual from Lakeview is talking about is the withholding.
It's nothing more than the withholding and may or may not cover the tax.
May not go, yeah, exactly. It might not be enough. Let's see if we can work through this one. He's going through, this individual's going through a divorce, has 5 children. Should he claim his claim the children on his tax return even though they're not living with him right now? Let's assume they're underage, they're still dependents.
It depends on their, it really depends on their divorce agreement, what he and his ex-spouse agree to. He needs to provide over the half of their support. And sometimes certain children are claimed on one parent and then the rest of the children are claimed on another. It's a balancing act that they need to work through, but there's tax benefits, of course, to claiming the children. Sometimes one person has more income than the other.
Okay. Here's a couple questions that are a little different. One of these is tied to something that folks might see on the television set here every now and then. Are there any disadvantages to having a reverse mortgage?
Disadvantages.
Well, let's
as
talk
I
for just a
understand it,
real
the
quick.
rates are relatively high. I've
Right.
never really analyzed one of these. I suppose that they can suit, you know, the needs of some people in some circumstances. You know, just to further explain what a reverse mortgage is, it's generally older people living in a house that's fully paid for,
Right.
taking payments to provide living expenses, and then on their passing, the house will be sold and pay that back. So, you know, it's something to consider.
Okay.
I wouldn't say there's a right or a wrong.
Excuse me. Yeah, but it really boils down to the situation. obviously,
Exactly,
and what
very
the
facts and
needs are for
circumstances,
cash.
very facts and circumstances type of thing.
Okay. Okay, here's one. Their first home is paid for. They bought a second home as an investment to get rental income out of. They'd like to know if they can collect the interest. Well, I think what they're talking about here, if they can recognize the interest as an expense on the whole property, or just on the portion that they're living in.
Sounds like this might be maybe like a duplex or a house that they bought on the same mortgage that they had with the original house.
Right.
I believe you have the option of making the election to deduct that on Schedule E or just treat it as home mortgage interest.
Okay. Yep, I'm not quite certain, but I think you're probably right in that assumption. Let's look at another question here. What are the limits on how much that an individual can give their children before there are any tax implications, either on an annual basis or a lifetime basis? Lynn?
There's currently an annual gifting limitation of $13,000 for 2012. It goes up to $14,000 in 2014, and that is an amount that you can gift to anyone. It doesn't have to be your children. One thing that is confusing to people often is they feel as if that should be a deduction for them, almost like a charitable contribution, but your children normally aren't qualified charitable organizations, and so usually we do talk about the $13,000 limitation, not a deduction for them and not income to their children or the receiver of that gift.
Okay, we've got a number of questions here dealing with retirement distributions. Let's take a look at a couple of these. 457Bs, do we know what they are?
Plans of nonprofit organizations.
Okay. Are normal distributions from a 457B plan taxable as ordinary income?
Yes.
My understanding, yes.
Okay.
Generally they are. They're
Okay.
pretty much the same as a 401k plan.
Okay, and the 403B would be the same?
Yes. it
Generally the same type of thing.
And if it's a 403B, here's a question from Lapeer. They asked for the 20% not to be deducted, but it continues to happen. Is that an election of any type or not?
It's a simple matter of paperwork with the group that is handling the investment, the one that makes the distribution to them, and so it should be as simple as filling out the right paperwork with that company. But the other side of that, if 20% is being deducted, even though they prefer it not be, they will get that refunded at year end if they don't owe that money to the government. So it's kind of in a savings account for them right now.
The 20% is a mandatory withholding rate for early distributions. I'm not sure if, I don't think they're referring to that. So
probably.
Typically, if you're taking a retirement distribution, you can structure your withholding like you want to.
Okay. Here's a question. Here's a question. They make this individual makes some money from car racing, but they've got expenses greater than how much they make. Is this a red flag to the IRS?
Well, you know, not necessarily. It becomes pretty obvious, I think, to most people if you have a business or a hobby. Unfortunately, a lot of people with hobbies try to pretend they're businesses and take deductions and losses. You have to run it like a business, and if you run it like a business, you're going to be able to claim your losses.
And there's also the hobby loss rules that potentially can limit you from claiming a loss more than 7 years in a row unless you can really show that you're in that business for profit. So those kinds of rules can be invoked if you continue to claim a loss every year.
And those cases go both ways all the time. It's, again, a facts and circumstances type of analysis that they look at.
But let's talk for just switch it just a hair. Let's talk about whether or not we've got startup businesses, and what are the expectations from the IRS in terms of how soon or how frequently do you have to have income over a period of time?
I think one of the things that they look at is if you start up a business and you're losing money, what are you doing to change that? What are you doing to try not to lose that money? And when you see with a lot of people that truly have hobbies, they don't make any changes.
Right. Right. Let's talk about something else here in terms of here's an individual who wants to take some money out of an IRA, presumably before their retirement age. Yes, they're still working. Is there an advantage to doing this in 1 year versus the next if they're going to have to do it anyway?
The only difference in taking it 1 year over and next is if their income would be higher in 1 year and the other, and that distribution of the IRA would actually put them in a higher tax bracket. That could cost them a little bit more income taxes, but they're going to pay the 10% penalty guaranteed, and then they're going to pay income tax at whatever their current taxable rate is.
So it's pretty much
normally it'd be a wash unless they had a spike in income.
Okay. Here's two sisters from Houghton Lake. They sold their mother's house, okay, that they had inherited for a certain amount of money. Is that, what are the implications here? Is that taxable to them? What's the base, how do they figure the basis on inherited property versus what you sell?
Generally not taxable. If you inherit something and sell it in a relatively short period of time, you get fair market value as the basis of that property when you inherit it. So when you sell it, there's typically no gain or loss involved in a situation like that.
Okay, question coming in. Is insurance, life insurance from a deceased relative, is that taxable?
No, that is not taxable. The only thing that people need to keep in mind with life insurance is if you qualify for a Michigan Homestead Property Tax Credit or the PA 116, the Farmland Preservation Tax Credits, that life insurance proceeds needs to be a part of your household income to calculate the credits, but it is not taxable.
Okay. Okay, a few minutes left here. If anyone wants to get on the, get on the phone, give us a call, get on social media to get us a question we might be able to get to. We've got another 6 or 7 minutes before we do have to call it quits this evening. Let's talk here a little bit about, once again, grandchildren and helping pay for college. What's the easiest way to help grandchildren pay for college without the grandchildren getting hit on a tax return from Nobbinway? Well, that's not necessarily taxable to them anyway.
No, it isn't.
Okay.
They can gift that money to the grandchildren. They can help pay the tuition. It's not a taxable event for either one of them.
Okay. Either way. Here's an individual from Hillman. Had a house foreclosed on in August, but has a 6-month redemption period. Okay. When will the 1099 be for, when will the 1099-C be for the average or the redemption period? I'm not sure I understand the last part of that question.
I'm not sure when they would issue that.
I'm not sure either. Those things have been very difficult to interpret. We've been seeing a lot of those over the last couple of years. We've seen them a lot of different ways.
Okay.
I don't know the answer to that.
No, and I'm not certain that I'm understanding the question completely. If you have a loan on your 401k, how is it treated after you turn 59 and a half? Does it matter?
I don't know that it's treated any differently if you don't pay it back, but if you choose not to pay it back and if you're old enough to take a distribution, it would seem possible that
You'd avoid the
you could
early
treat it
distribution.
as a distribution,
penalty.
yes.
Yeah, if you were older than 59 and a half when you stopped paying on the loan, you know, there's various rules associated with that. It'll be declared income, it'll be reported to you, but if you're over 59 and a half, you won't have the penalty.
We don't have the penalty. Here's a quick kind of a little investment question. Are annuities considered to be a safe investment?
That's what they're invested in.
Yeah, let's talk about specific annuities that might be coming out of either insurance companies or through your brokers. Any thoughts you want to give on that? That's a question from Farmington Hills.
I think the caveat is just that you need to read the agreement, the paperwork that comes with the annuity very carefully, because just from the experience I've had with my clients, some will state clearly that there's a guarantee or a floor, a level that they can't go below, and others are not at all clear that your original investment will be retained and that you can't lose it.
Question from Shelby Township, receiving survivor benefits from Social Security because her husband had passed away. Will she lose these benefits, if she remarries?
You know, I'm not, there's a lot of different formulas. I don't know the answer to that. I think so. If she remarries, I believe then she falls under, yeah, I don't know the answer to that. That's a question for Ask the Social Security.
It is.
Right.
It's really not a tax question. It's Social Security Administration would be the people to contact and ask that question.
Yeah, that's a good point. Has the governor changed the rules on property tax and mortgage interest deductions for next year? And we talked about this earlier.
This person's confusing federal law with state law.
So the federal laws are unchanged, and Governor Snyder has no input on those.
That's right. If I sell my home for less than I owe on it through a so-called short sale, what are the tax implications?
Well, it's generally considered income, but there's laws on the books right now. I'm not sure when they expire that that type of relief of debt is not considered income for homeowners.
I think that, I mean, that's pretty much it.
Totally
Exempt
agree.
under,
Yes.
I believe that law might expire at the end of this year.
That's what I also think. 2012,
does?
it might be expiring.
And if it expires, then it would return to being income.
Then you would get a 1099-C on that also.
Yep.
And then there's other measurements to go through if you're solvent or insolvent as to
Yeah,
whether
just
it
reaffirm,
may or
you
may
reaffirm
not
the
be
debt,
taxable.
things such as
Exactly.
that.
Exactly.
Okay, all right. Here's a question that applies to a lot of people in a general sense. They're starting a business and they have a lot of supplies, wondering if the cost of those supplies can be deducted before a profit is made, or if they should wait. Kind of a timing difference. They may have been stuff that they had as an individual for hobby. Now they're putting it into the business, trying to decide when and if to deduct the expenses.
Well, there's a number of rules associated with that if they were personal assets first, but there's also a lot of new rules associated with those types of things. I mean, if they're purchased before the end of the year but not used, there's considerations to be made there as to which laws apply to you.
And they might want to consider if those supplies would be of an inventory nature. If they're going to carry those as inventory and sell them later, then definitely they would carry those over to the time period that they sell them. But if they're supplies just of an ongoing nature and their business shows a loss in the first year, because many businesses do in a startup year, then I would think they're likely to be deductible in the current year.
Okay. Just a question or two here as we start to wrap things up. What if you want to gift something to someone you're not related to, for college or anything else? Doesn't matter, does it?
It does not matter who you gift to. You can gift to anyone.
Okay. All right. Good question. And what are the issues, if any, with pension plans that people ought to be looking at if they still happen to be working after 59 and a half or into their 60s? What are some of the issues that they might want to consider in terms of either supplemental payments or other things such as that?
Do you mean in terms of contributing?
Yeah, presumably in terms of contributing, not in terms of taking a distribution if they're still working.
Well, you're always going to want to change your investment portfolio, assuming that you have a choice in the assets that your pension money goes into. You need to get very conservative with your investments because you're coming to those years when you're going to be collecting on that. So it's a good time to tweak your strategy.
Okay, let's. We've got a question here from Farwell. This individual was left an IRA by her father. Is there a penalty for her taking the money out if the IRA was created by the father? And if there is, what's the penalty on it, or what's the appropriate tax rate?
Well, generally speaking, it depends on whether the father was already drawing on the IRA or whether he was not drawing on the IRA. And if you have to draw it out within 5 years, or you may be able to elect to draw it over your life expectancy.
Okay, and let's see here. They're individuals living in a house that's going through a short sale, and this question really isn't a tax question now that I read it. They're renting it. The owner didn't inform her. And is there any issues, any ways that she can still live there because she wasn't informed?
That's ask the lawyers.
That's ask the lawyers, isn't it? Okay, I think that we're about done. Fast half hour. I want to thank both of you for joining us. I want to thank Keith and Lynn for being with us this evening. We do appreciate it. I want to thank each of the individuals who called in with their questions, and also our phone volunteers who've taken the time to answer those questions. Remember, the viewers, that you need to check out the facebook.com/askthespecialist, and for answers to any of the questions that we didn't get to tonight, we'll try to get those out there. Ask the Specialist will return in December with some non-call-in specials. I'm Ed Grant. Good night.
Support comes from Smart Investing at Your Library, a partnership between the Genesee District Library, FINRA Investor Education Foundation, and the American Library Association. The mission is to provide the public with knowledge, skills, and tools necessary for financial success throughout life. More details at thegdl.org.